These are the new federal tax breaks for older adults under the One Big Beautiful Bill, and this video explains what they actually do, who qualifies, and why the relief feels far more limited than many seniors first expect. This is a clear, grounded explanation of how the law changes federal taxes for people age 65 and older, and why those changes matter most after retirement income replaces regular paychecks. For many older Americans, the passage of the One Big Beautiful Bill in 2025 arrived during a period of real financial uncertainty. Retirement today looks very different from how it looked for earlier generations. Expenses no longer reliably decline after work ends. Healthcare costs rise, insurance premiums fluctuate, housing expenses remain stubborn, and savings must stretch across longer lifespans. Against that backdrop, any law promising tax relief for seniors naturally draws attention. The One Big Beautiful Bill is a federal tax and budget law passed by the United States Congress and signed into law in 2025. It covers a wide range of tax and fiscal issues, but buried inside that larger package are provisions aimed directly at older adults. These provisions are administered by the Internal Revenue Service and overseen by the U.S. Department of the Treasury, just like other federal tax rules. At the center of the senior-focused changes is a new federal tax deduction available to older adults who meet age requirements. This deduction does not replace the standard deduction. Instead, it stacks on top of it. That structural detail matters because it determines how the benefit works in practice and who gains the most from it. By layering the deduction on top of the standard deduction, the law allows qualifying seniors to reduce their federal taxable income by an additional fixed amount. This reduction applies only to federal income taxes. It does not automatically affect state or local taxes, and it does not change how income itself is calculated before deductions. Eligibility for the deduction is based on age rather than retirement status. Adults who meet the age threshold qualify whether they are fully retired, partially retired, or still working. This reflects a deliberate choice by lawmakers to avoid defining retirement or tying benefits to specific income sources. Age is used as the proxy for financial vulnerability later in life. That approach simplifies eligibility but introduces trade-offs. Because age alone determines who can qualify, the law includes income thresholds and phase-outs. As income rises beyond certain levels, the deduction shrinks and eventually disappears. The result is a benefit that is most valuable to seniors with low to moderate incomes, while providing less or no relief to higher-income retirees. Married couples receive special treatment within the same framework. When both spouses meet the age requirement, they may claim a combined deduction. This mirrors how other age-based tax provisions work, and acknowledges that many retirement households depend on joint income streams rather than individual ones. One of the most important limitations of the deduction is that it exists only at the federal level. States are not required to follow federal tax changes, and many do not. For seniors living in states with high income or property taxes, the federal deduction lowers federal taxable income but leaves state obligations untouched unless state lawmakers act separately. This distinction shapes how the deduction feels in everyday life. Federal taxes may decrease slightly, yet overall tax bills remain high due to state and local obligations. Seniors who expected sweeping relief may feel disappointed when the net effect turns out to be modest. Another defining feature of the deduction is its temporary nature. The One Big Beautiful Bill does not permanently embed the senior deduction into the tax code. Instead, it applies only to a specific set of tax years. After the final year outlined in the law, the provision automatically expires unless Congress passes new legislation to extend it. This sunset clause changes how the deduction should be viewed. It is not a permanent fix or a structural overhaul. It is a temporary measure designed to provide near-term relief rather than long-term certainty. Seniors who treat the deduction as a lasting feature risk being caught off guard when it disappears. The deduction becomes available beginning with the first filing season after the law's enactment. Seniors must actively claim it on eligible returns. It does not apply automatically, and it does not retroactively reduce taxes for earlier years. Missing a claim during an eligible year means forfeiting the benefit for that year. Following passage of the law, the IRS entered a guidance period. During this phase, the agency issued rules and clarifications explaining eligibility, income thresholds, and how the deduction interacts with other parts of the tax code. This guidance matters because most seniors do not have simple tax situations. Retirement income often comes from multiple sources: pensions, retirement account withdrawals, investment income, and other payments all combine into taxable income. The new deduction fits into that structure rather than replacing it. Understanding where it applies and where it does not determines how much relief it actually provides. One key clarification is what the deduction does not affect. Claiming it does not change Social Security eligibility or benefit amounts. It does not affect Medicare coverage. It does not change Medicare premiums. It does not reduce state or local taxes. Its impact is confined to federal taxable income. This limitation is where expectations often diverge from reality. When seniors hear about a new tax break, many assume it will meaningfully change their overall financial situation. In practice, the deduction lowers federal taxes but leaves many of the largest retirement expenses untouched. The deduction does interact with other federal tax rules in subtle ways. By reducing taxable income, it can slightly lower effective marginal tax rates. It may influence how other deductions or credits apply. For some seniors, this interaction produces modest additional savings beyond the face value of the deduction itself. At the same time, the deduction does not address structural pressures facing retirees. Healthcare costs continue rising. Housing expenses remain high. Insurance premiums fluctuate. State and local taxes persist. Senior advocacy organizations have emphasized this point, describing the deduction as relief rather than resolution. Public statements included in legislative summaries and advocacy commentary consistently frame the deduction this way. Lawmakers highlight rising costs and the reality that many retirees struggle to keep pace with inflation. The language avoids promising transformation and instead emphasizes targeted assistance. Debate surrounding the deduction reflects broader disagreements about tax policy and retirement security. Supporters point to simplicity. A deduction is easier to claim than a complex credit. It requires less documentation and integrates cleanly into the existing tax framework. Supporters also argue that age-based eligibility avoids administrative complexity. There is no need to verify retirement status, income source, or employment history. If a taxpayer meets the age requirement and falls within income limits, the deduction applies. Critics focus on limitations. The temporary nature of the benefit creates uncertainty. The income phase-outs exclude many seniors with higher retirement incomes. The deduction does not address state and local taxes, which dominate the cost structure for many retirees. Another criticism centers on timing. Because the deduction applies only during specific tax years, seniors who retire outside that window or experience higher income during those years may see limited benefit. Planning around a temporary provision adds complexity rather than reducing it. Geography also plays a role in how the deduction is perceived. Seniors in lower tax states may feel more relief because federal taxes make up a larger share of their overall burden. Seniors in high tax states may notice little change, even with the deduction in place. As of the most recent update, the One Big Beautiful Bill remains in effect, and the senior deduction is available for eligible tax years. IRS guidance continues to evolve as filing seasons progress. Seniors must decide how to incorporate the deduction into their broader financial planning. Understanding the deduction requires separating what it does from what it does not do. It reduces federal taxable income during eligible years. It does not eliminate taxes entirely. It does not change retirement income rules. Its value depends on income level, filing status, and interaction with other deductions. For seniors with modest incomes, the deduction can provide meaningful relief during the years it applies. For others, especially those with higher retirement incomes, the benefit may be limited or non-existent due to phase-outs. This uneven impact explains why reactions to the law vary widely. From a planning perspective, the deduction works best as a supplement rather than a foundation. Seniors who treat it as a bonus rather than a permanent feature are less likely to be surprised when it expires. Conservative planning assumptions reduce the risk of future shortfalls. The One Big Beautiful Bill reflects a broader pattern in modern tax policy. Rather than sweeping reforms, lawmakers increasingly rely on targeted, time-limited measures. These changes provide incremental relief without restructuring the system. For seniors, this means vigilance matters. Temporary provisions require attention. Benefits must be claimed actively. Expiration dates must be tracked. The burden of adaptation remains largely on individuals. This law also highlights how retirement security is shaped less by any single policy and more by the accumulation of rules. Federal taxes, state taxes, healthcare costs, housing expenses, and longevity all interact. A single deduction cannot solve those challenges on its own. The senior deduction under the One Big Beautiful Bill acknowledges financial pressure without fully addressing it. That acknowledgement matters, but it does not change the fundamental reality that retirement planning remains an individual responsibility within a complex system. For seniors deciding how to use the deduction, the most practical approach is moderation. Use the relief during eligible years. Avoid building long-term plans around it. Prepare for its expiration. Focus on sustainability rather than short-term gains. This perspective aligns with how advocacy groups describe the law. The deduction is framed as help, not a cure. It eases pressure temporarily but does not redefine retirement affordability. The broader lesson of the One Big Beautiful Bill is that retirement security is increasingly managed through small adjustments rather than large guarantees. Seniors benefit most when they understand those adjustments clearly and respond cautiously. This is the full reality of the new federal tax breaks for older adults under the One Big Beautiful Bill. They provide real but limited relief, available only for a defined period, within a system that continues to place most responsibility for financial security on individuals. Understanding the scope and limits of this deduction allows seniors to use it wisely, without overestimating its impact or relying on it too heavily. That clarity, more than the deduction itself, is what ultimately protects retirement stability.